Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastori. China-U.S. relations have been tense, to say the least, with continued uncertainty around the Russia-Ukraine war and Speaker Nancy Pelosi's recent trip to Taiwan. With China accounting for over 1/3 of the emerging markets index, even investors who don't directly buy China can't ignore the risk because they likely have a big part of their global EM allocation in Chinese stocks. So what does the U.S.-China relationship look like down the road? And is it a good time to be an investor in China and EM more broadly, of course? So let's talk about that now with our two guests, Jason Su and Phil Wool, both from Rayliant Global Advisors. Gentlemen, so nice to have you on the program with me. There certainly is a lot to discuss within the U.S.-China relationship. And as I mentioned in the intro, a lot of geopolitical stories that are going on. The landscape, of course, is very rocky, to say the least. So Jason, let me start with you. What does the U.S.-China relationship actually look like as we look down the road, given where we are today with our relationship with China?
Anthony, I think a lot of people want to use the imagery of a Cold War 2.0, right? We want to see this as sort of, U.S. versus China in the way of U.S. versus Russia. I would propose a different analogy. I would propose co-opetition as the model for understanding U.S. and China going forward. And that, of course, harkens back to sort of the U.S.-Japan relationship as Japan was rising. In a co-opetition, there's clearly competition. So it's going to be tense, it's going to be uncomfortable, and there's going to be negativity towards your competitor. But because there's enough trade and that co-opetition, that competition is good for everyone, that you won't ever let the tension get out of whack. So that's what I see as U.S. and China going forward, co-opetition. And within that role, how should you see U.S. and China? You don't want to see this as, oh, bet on China overtaking the U.S. Because that's not at all what's going to happen. What you'll have is U.S. will continue to be that innovation driver, driving the GDP forward. Right? It's the scientist in that pairing. And China will be a fast follower with a massive market and with sort of that engineering-like precision to cost down. And the pair of them are going to be the twin growth driver for the economy going forward. And I think there's a beauty in that collaboration. So this is not about betting on China versus the U.S. This is about betting on the two most important growth drivers for humanity and for our global economy.
Thank you, Jason. Yeah, it's a really interesting story. The political landscape certainly is something that we're all keeping an eye on. And to kind of continue on that, Phil, let me bring you in here because some of, especially in the U.S. side, we may not know that the 20th National Congress of the Chinese Communist Party is happening this year, later in November, just around the time that we have our midterm elections here in the U.S. So the question then begs, what do the politics actually mean for investors, given what is going to be happening towards the end of the year in China?
Yeah, that's a great question. You can look at this almost like an election year in China as well. And it's not just President Xi Jinping going on to a third term, but it's really a whole slate of political appointees. And this is at local levels of government. We're talking appointees at state-owned companies, all the way up to the national level. And this is going to be an opportunity for China to really make a formal, decisive pivot from policies that were really geared towards social change in China over the last year and a half to much more growth-oriented policies. So I think for investors, this is probably a really good time. And then the other aspect of this National Congress is that in the lead up, because Xi Jinping and the state want this to happen against a backdrop of financial strength and economic stability, you're going to see continued stimulus through the end of this year. And the important implication of that, of course, is that China is getting really accommodative at the same time that the US and other major economies are really aggressively tightening. So from a diversification perspective, investors allocating to China, this is a big opportunity going forward through the end of 2022.
Thank you, Phil. Jason, it's really interesting. I think there's probably not a lot of folks out there watching this program who don't understand the economic power that China has or, continues to have. And I was looking at a stat, something like 698 billionaires in China, trailing the U.S. only by a little bit, somewhere around 720 billionaires in the U.S. And by the way, since 2020, up until just last month in 2022, both countries saw tremendous growth in billionaires, likely because of the opportunities that some of the wealthier folks took in the markets post the initial shutdowns. So let's talk about China's economy then. It has seen growth, as we know. But the bottom line is, does that mean that investors, folks who are investing in EM and in China stocks, are actually seeing growth in that arena?
Anthony, first of all, you hit the nail on the head. GDP growth, economic prosperity don't always translate into stock price improvement. It doesn't always translate into corporate earnings growth. And in fact, that is universally true in most of the EM. For the last 15 years, a lot of EM countries have phenomenal GDP growth, but not corporate EPS growth. That hasn't translated into the stock market. China, in that sense, is somewhat unique within the EM basket, that it has this phenomenal ability to transform what's happening in the brick and mortar economy into the stock market. So if you look at the last 15 years, the way China has delivered stock market return was in large part by driving earnings per share growth, right? There's been strong EPS growth, and that's driven by the underlying strength in the economy. That's actually rare in EM. In EM, you don't see that relationship. Now, if you contrast that to what's happening in the U.S. the last 15 years, a lot of the U.S. stock market return was, of course, part of that was fundamental EPS growth, but a lot of it has been valuation multiple expansion. And so if you compare two types of stock market return, I think generally we prefer to see prices driven by fundamental improvement because that's more likely to persist and repeat. And so if we sort of take that all in, what does that mean? Well, that means if you want to buy growth, and you buy in the U.S., it's generally expensive, but you could buy growth in China and buy a lot cheaper. You just have to be willing to take some fear premium, right? The fact that China is scary, it's uncomfortable. There's some negativity in the U.S. right now against China. You're getting that discount for buying growth, and that's a rare opportunity if you're willing to take some discomfort in your stomach.
Yeah, Jason, I'm glad you brought that up because I think there is a sentiment, especially on the U.S. side, about that negativity and when you're thinking about China and their place right now in society. So, but I'm glad you brought that up because it is one of those sticky subjects that people don't really like to talk about, especially on the investing side, but it's certainly worth talking about. And by the way, I want to go back to that word you used, co-opetition. I really think that word says so much in just a few letters. So thank you for sharing with us that word with us, Jason. So Phil, let me follow up with you as we're wrapping up our conversation here. Given everything we know, given Jason's kind of reminder of the fact that there is some negativity surrounding China, but there is this tremendous growth. I mean, looking at that previous chart, China was an outlier all the way by itself in the upper right-hand corner with GDP versus earnings growth. So where is the opportunity right now in China's market?
Yeah, so a key point in terms of the growth story in China is that all Chinese stocks aren't created equal in terms of their access to that growth. So you can think about two types of Chinese stocks. There's offshore China. Those are the names you probably heard of, the Alibabas, the Meituans, the Tencents. Those are traded in the US or in Hong Kong. And then you have onshore China. These are the mainland listed A shares, companies that you probably haven't heard of. And it turns out that most of the growth that Jason's talking about is actually being driven by those onshore listed companies. And the diversification I mentioned before, that's also primarily concentrated onshore. So the first aspect of the opportunity is that you really want to focus on the mainland listed A shares. And then the second point, and this gets to the risks that we've been discussing and some of that negativity, when you think about all of these risks, many of which are really unfamiliar to developed markets investors, and then beyond that, the fact that in the mainland market, about 85% of trading is done by amateur individual investors, not sophisticated institutions. There's a lot of mispricing. There's a lot of opportunity to more effectively manage risk as an active manager. And so China is one of those places where you really want to take an active approach. And so just to give you examples of some of the things that we're seeing in boring sectors like materials, chemical companies, you'll find bargains, stocks growing really quickly that happen to be critical parts of the new energy supply chain, but retail investors in China just don't realize it. You've got domestic semiconductor companies. They're part of this technological competition, and they're getting huge state subsidies, part of that fiscal stimulus that we talked about. And so for active stock pickers looking at the onshore market, there are huge opportunities. And I think, lots of growth and diversification diversification, but also potential for alpha because there's so much of this retail-driven mispricing in China.
Right. Phil, I like how you describe it, sort of the boring sectors, right? That's where you kind of look for the best discounted opportunities. So that's great to hear. Phil, thank you very much. Phil Wool, and also thank you to Jason Su, both from Radiant Global Advisors, great partners to UBS, and thanks for all the content that you shared with us today, gentlemen. Good to see you.
Thanks, Anthony.
Thanks, Anthony.
My pleasure. We'll have you back soon. And for more information from Radiant or any of our other partners at UBS that are coming out of our research teams, like the Chief Investment Office, you can visit ubs.com/views. Certainly, there's a lot of information there that can be shared specifically from the folks here at UBS and the leadership and intellectual capital we get from partners like Radiant Global Advisors. So you can make sure to also follow UBS on social media. We're on LinkedIn, Facebook, Instagram, and Twitter. Plus, check out all of our past UBS Trending episodes on demand. And as always, if you have any questions about how anything we spoke about today impacts your own portfolio, make sure to speak with a financial advisor. Until next time, I'm Anthony Pastore. We hope you have a great day, and remember to keep your eyes on what's trending. We'll see you soon, everybody.